what's going on with the rates this week? Well, although they ticked up slightly, there was not a lot of movement this week, and we're not expecting anything until the end of this month. But if you're worried about the rates, let me give you 5 tips to avoid a high interest rate. It's important to understand that there are government-backed loans, conventional, FHA, and VA, all with their own guidelines. There's also USDA if you're out in a rural area. Then there are loans from a bank or credit union. They're loaning their money without selling that loan off to one of the government pools, so they can do what they want. But for a typical buyer, the better rates are within the 3 government loans, conventional, FHA, or VA. FHA and VA are pretty straightforward and allow the buyer to use less cash for a down payment than the conventional loans. Conventional loans are the ones you hear about with the rate updates and all that kind of stuff. So let's talk about them. And if you're getting one of those loans, how you can best lower that rate. When you get a loan to own a house, you'll sit with a loan officer, phone, Zoom, in person, whatever, where they'll pour through your finances and they'll put all that into the computer, run a program connected to the government guidelines, which will then spit out a yes or no result and a rate. There are a few things you can do before that to lower your rate. So here's the 5. Number 1, pull a credit report yourself. I'm not talking about Credit Karma. I'm sure they're great and wonderful people, but I found that Experian is closer to the scores of a mortgage lender than any of the other sources. You want to be as high as possible, above 720 if you can. The quickest ways to do this are to pay any collections and try to get them completely removed. Now, we do have reputable people to help with that. If you need them, just reach out. The second way to immediately raise your score is to either pay down your credit cards or raise the available credit. That will improve the ratio between the balance owed and what's available, and the lower that number, the better for your rate. But don't go to 0, because that's a red flag too. 7% to 15% is about the sweet spot, and the higher your score, again, the lower your rate. Number 2, the banks go back 60 days for all your bank accounts and could deny your loan for non-sufficient fund charges. So if you have them, open a new account, put your buying money in there, wait 60 days to shop. You only have to disclose the money you're using for purchase and for reserves, and they do like reserves. If you have 6 months of payments stashed in the bank, they love that. Number 3, consider a buy-down loan. This is where you pay some upfront interest to lower the rate for up to the first 1 to 3 years, at which time your rate will move to where you would be at today. It gives you time to enjoy a lower payment and even take advantage of a drop in rates should that happen in that time period. You can also pay points or upfront interest at closing to permanently lower your rate. Number 4, part of your rate is what the computer thinks about your debt ratio. That's the gross amount you make every month compared to your expenses that are on your credit report, including the proposed new mortgage payment. Revolving loans are there no matter what, like credit cards, but installment loans are only counted if they have more than 9 payments left. We once had a buyer pay 3 car payments so that it would not be counted against their income. Score bounced right up, and this won't work on leases, just on loans. Student loans too. If you're coming up on the end of a deferment, see if there's a way to extend that deferment so that the payment will not count. Talk to your lender about this. Talk to your lender about all this before you do anything. Multiple loans. Number 5. You may have heard that good credit people are going to pay higher interest rates for bad credit people. That's not true. That was going around several months ago. And what actually happened was that the computer models took a look at which mortgages caused the highest losses and found that 20% down loans were the loss leader because they had no private mortgage insurance to back them. I did do a video on all this before, so I'll just cut to the tip. If you're putting 20% down, consider getting a 70% main loan with a 10% secondary loan. The rate on the little loan will be a little bit higher, but the rate on the big loan will be lower. You could also do this in any combination up to a 90% total loan, meaning an $800,000 house with a combined $720,000 loan or loans. This is also a great tip for people with less than 20% down to avoid PMI, or people who have to buy before they can sell. They can get 2 loans, buy their new home, then pay off the secondary loan when their existing house sells. Talk about a stress reliever when you have to buy and sell at the same time. If you have any questions on how these strategies can be used in your particular situation, please don't hesitate to give me a call. This is Bill Eaves, Associate Broker with RE/MAX of bensalem, licensed agent with RE/MAX in New Jersey. And as always, thanks for watching.